All right, what's up, everybody? I am super pumped to have a conversation with Bill Dallas, one of my OG mentors, dating back. God, Bill, I mean, it's over
Long time. Oh,
a long time. I,
it's like we don't even want to go there.
yeah, I was in mortgage. I had been in mortgage for 38 years. And when did you found First Franklin?
81, January of 81.
Okay, and I got so you that was well rolling. All I know is that was my favorite lender I ever worked with. And
Thank
after
you.
I became one of on your advisory panel and saw how you ran that company, it really made a difference. Like a lot of the interviews I do, how customer focused I am, uh, you are someone that had a lot of influence on that. So thank you, brother.
You're welcome, man.
So for anyone that's new in this business, I think you can just Google Bill Dallas, and he's got his hands on a lot of things. You're talking about one of the legends at the C-suite, has founded mortgage companies, has sold mortgage companies, has bought them back, has built schools. Uh, Now is spending a lot of time just giving back from an impact standpoint. He's on the board of advisors for First Home IQ. Thank you for
Welcome.
jumping in and helping all the ways that you do. And he knows a lot about what's happening in lending. And so Bill and I, a couple of weeks ago, we were just having a little chat over the phone about LO Comp. I had made my first post on LO Comp
Mhm.
on LinkedIn, and we were like talking about LO Comp. And then within
We
the
sort of went off. We sort of went off.
we did go off.
We
We're gonna
did.
make some of that. We're gonna make some of that conversation
See if we
public.
can do that again. Yeah.
Yeah, but we're like, man, we got to have this conversation in public. So we're going to talk about LO comp. And then we're also going to talk about non-QM lending. Bill, one of the things that came up in that conversation is Bill said he thinks we're going to see more 5-year, 7-year interest-only ARMs in 25. So Bill, let's just get right into LO comp. I started my post not to say that loan officers, you need to lower your comp, although some loan officers do. But I really came into it that the mortgage industry needs to look at pricing, and they need to look at product. Like the product is
Mhm.
not government versus conventional. The product is the borrower experience. Like what is the full borrower
Mhm.
experience? And if you have a good conversion rate, there's a good chance you're priced right, both as a lender and loan officer. And if you don't have a great conversion rate, there's a good chance that you're not. If you have a lot of price exceptions, there's a good chance that something's off. So what are your thoughts? Because you're consulting the C-suite, a lot of
Yep.
lenders, how do you approach that conversation?
Yeah, I think I start with the idea that we don't want to miss this next refi wave, and this wave is going to be totally different. And it's going to be different because it's not going to be this avalanche of rates declining or a moment in time like we experienced with COVID, right? Where suddenly the bottom drops out of interest rates, and now everybody wants to attack. This is going to be different. So, and I start with the idea that there's probably three types of originators, right? I'm going to take uh, retail LOs, where you and I both came out of that business, mortgage brokers. I'm going to take banks and call centers. And when you look at the swath between them, right, especially for refinances, right? Refinances on the bank owned guys are probably 60 bips. You're looking at the front end people in a call center anywhere between 20 and 40, maybe a little higher. And then you move up and now you start looking at mortgage bankers or brokers, right? Right now you've got some tension between banking and brokering just because it's cheaper and lower rates are being offered by mortgage brokers because they've got other sources. They don't have a lot of overhead. And then you've got the retail mortgage banks. The overall cost to produce the loan, no matter almost where you get it, is still way too high. So you're looking at $12,000 to $15,000 a loan, right? Just to get loans funded. Some of that's compliance cost, and some of it's AE or broker comp or LO comp. So my view of it is that how are you going, if I am a retail loan officer, and so let's speak to our people, right? If you're a retail loan officer and you're sitting there looking at my average comp plan was probably $1 to $1.25. right? And this was at Skyline, this was at Finance of America, this is all current. My top LOs, and I'll say this again, my best loan officers always had comp plans a little bit below that. They were always at 90 or something, right? And so what that was telling me was that, you know, if you have fewer transactions, you want to make more money, right? For the 2 or 3 loans. Look at average loan officers today are doing between, I just saw some public information. You're probably at a loan a month right now, right? On an average LO, maybe 2. And so most of my top ones are doing 5 to 10, maybe more. You're looking at when you're in a call center, you're probably doing 10 to 20. Average is probably 15. So I think as rates decline this time, we are going to have 2 separate comp plans. And one has to be for refinances. And you can do that legally under Dodd-Frank. You just have to create it as if it's a referral so that you can actually reduce the comp. And we did that, and we had everybody opt in to get in preparation. And when I'm talking to my clients today, you need to tune up your lead gen, you know, because we're going to be competing with call centers and big servicers who are going to try to keep these clients, and you must prepare for each loan. And I think what that'll do is you just have to overhaul your comp plan in order to make this happen. So
Yeah.
that's where you and I started, right?
Yeah.
And
So
thinking about it.
And I think I don't think I had talked to Mitch Kiter when you and I talked last. So it's just for you, Bill, to know, I talked to Mitch around this topic, and I learned, I did not realize that you can give incentive compensation for conversion rate. So Mitch brought that up as a thing. He agreed with me that conversion is really the North Star. And so also I've talked to a lot more loan officers. I've had people, I even had a comment on one of my LinkedIn posts, I think it was yesterday, where someone made a comment that, hey, if a lot of loan officers, if they had to lower their comp, their basis points, they'd go out of business. And I was kind of like, well, I think you're missing the point, because the whole idea and where I started this conversation is like, hey, loan officers, like, let's say there's 100 in a room. I'd say, raise your hand if you're hitting your financial goals and you're hitting your production goals. And the people that raise their hand, first of all, there wouldn't be very many of them. Yeah, there wouldn't be a lot of them. And by the way, even the people killing it, doing over 100 million a year, they probably wouldn't be raising their hands. You know, they're like, and then I would go, but if you are, like, if you're listening to this right now and you're a loan officer and you're hitting your numbers, then you're probably priced pretty good. But if you're not, let me ask you another question. What is your conversion credit report where disclosures are triggered, where expenses start tallying it up for your organization, and how many loans you close? What's your conversion? And if you are in the top 10 or 20% among your peers, there's a good chance that you're priced right. But the problem is most aren't. And so if you don't have a great conversion, if you're not hitting your goals, 2 things I would say. One, consider your price. How does that compare against your peers? And then 2, even more impact than that, what is the experience you're delivering to the borrower? And if the experience you're delivering is, oh, here's your rate, here's your fee, here's your cash to close, that's your product. And that is a commodity, and it's going to go to the lowest bidder. It can be automated.
Well, and I think that's what this one, right? I think in the old days, and I'm going to say, I think if you were within, we always used to say that if my interest rate was within an 8, then I'm going to get a great loan officer is going to get the loan.
Really,
I'm not
it's
so sure.
3 8. I see a lot of loan officers that are able to, especially in this market, because if you're using MortgageCoach, you can show, hey, here's the competition versus me. What's the cost over a year or 2? Because the interest rates right now are high. Every consumer believes rates are going to come down. And all you need to do is show what is the total cost over a year or 2 years. Because That's how long you're likely going to have this loan. And now you dollarize that cost. And it's probably 1,000, 2,000. And if it's a couple $1,000 over a year or two, you're gonna win that loan. Now, if it's over $5,000 over a year or two, maybe we're gonna need to do a concession. But now you're negotiating dollars, not eighths and quarters and 3/8 in rate.
Yeah. And I think the concession component. So if you look at what's changed, coming out of 06, 07, and 08 with Dodd-Frank and then the change in comp laws, I think the two things that are problematic are one, concessions, and they have to be borne by the company, right? And two, every loan, basically a 30-year fixed rate loan product, all has to be at the same comp, right? And I'm not so sure that either. I mean, look, I'm not going to win this argument, but I'm not so sure that that's true. And so I think what we proved, and what I would caution people to do and look at when they do it, that a refinance from an existing customer that's an established customer that you've done 20 loans for is different than a purchase loan from somebody I just met. Right. So I could see myself being a $120 comp, on a new originated loan purchase, especially. And like you and I started in my history in mortgage, purchase loans almost are for categorically for 40 years, purchase loans are more profitable per loan by about 25 basis points than a refinance.
Right.
So you start thinking about, now if I want to refinance and I have to compete with a call center, now let's just say I've closed this loan in COVID, clients at 3.5, and we sold the servicing. Servicing goes to one of the bigger players. They now have call centers. That client comes back to me, right? Let's just say out of sheer, just great. And I used Trust Engine. I used MortgageCoach. I have all the tools. I had the trigger lead. So I've got the client. Now that client is at markets at what? 6.5, right? Let's say rates begin to decline. So how am I going to compete at a much higher comp plan with the person that owns the servicing, where they're making their payment, who's probably at 40 bips, maybe less? That's got to be a point, and it might even be a half a point in rate difference.
Right.
So that's my point, is get ready for that. You're going to have to compete for each loan. And so tune yourself up, because I think great loan officers do a wonderful job at getting the first crack at this. But if I'm a consumer and I'm making my payment to whoever, and I have a relationship with that person, I've always said to my loan officers that the two most vaunted words in mortgage would be note modification, right? Because if I could modify the note without doing any additional work, no appraisal, and look at how things are today, right? You can get waivers, you can get PIWs, you can get all these things from the agencies. So if I am going to have to compete with somebody that might be able to do an equivalent of a mod, then how am I going to do that? And like you said, I think we can still win, but we have to overhaul our comp plans. I don't think we can be at a $120. Doesn't mean we have to be at 20 or 40, but it does mean we have to be in the hunt. We've got to be really good at what we do. So my point would be, let's get ready now for referral-based past clients, where we could actually prove that we can do this at a different comp plan. Let's opt in to the program, do the trigger leads, have somebody make sure that all this is set up for us, and then be ready to sell.
Yeah. So a couple of things. So one, I think it's important to go beyond trigger and get to the consumer earlier. By the time that inquiry is hit, the borrower's already shopped, they're already in the game with someone else. So get more predictive. I call that speed to need. Like, here's a framework. These are the three P's that I talk about all the time from stage. Here, let me blow that up just a little bit. Price, which is your rate and your fees. And from a loan officer standpoint, that's the basis points you charge and what
Mm-hmm.
your lender charges. So it's a combination of cost and profit expectations. And here's my message: profit-driven LOs price for database share and market share. Like, they're not
Mm-hmm.
just trying to win every loan. I was like, I want to get every loan, like what Bill's talking about. You want to optimize your database share and optimize your market share. You gotta think differently, and then think of your product differently. Profit-driven LOs help borrowers build wealth with real estate faster at scale.
Mm-hmm. Mm-hmm.
So you want to be this is what a price loan officer quotes like, and this is what a loan officer that helps solve a bigger problem. I'm going to help you build wealth with real estate faster. I'm going to help you
Yeah.
pay off your mortgage faster. So think about your customer experience differently, and then process speed to need. Get to that consumer's need more preemptively, more effectively. And and then again, execution. Whoever could do this at scale,
Yeah. Sort of
process
seamless. Yeah.
consistently to where it's
Yeah.
just like boom, boom. We are getting to scale. We're going beyond, you know, like, trigger alerts are good. Like, this is a good thing, but getting there sooner, like predicting the sweet spot, is better. And then be able to predict both purchase and refi opportunities and get to the consumer first, like speed to
Yeah.
need. And then
So when I started going through this process with my clients, right, it was interesting because I think we're in the business. We've been in most of these folks have been in the business 25 years, right? So we have an agency view. And what I tried to do is say, okay, so what is different about this refinance? Well, this refinance is going to be cash out. This refinance is going to be, this is not going to be rate and term, right? So whole different kettle of fish, not what the agencies do well, right? And the first fall point is going to be like you and I talked. The first is going to be, and your first options for an LO are going to be non-QM. It's going to be a HELOC, which is non-QM by definition, or it's going to be a interest-only loan, which also is non-QM. Why? The curve has now de-inverted. You're now getting this nice sort of ramp. You're going to start, the first products you're going to offer to these new consumers is going to be an IO.
so
If
by the
you're
way,
not,
let's transition. Are you seeing that right now? Like, are you
yeah,
seeing
I'm
IOs?
seeing it at every bank that I've already seen. I don't see it as much in mortgage banks because most mortgage banks are about 20% refi
Yeah,
and
well, I'm
about
seeing
80%
it. I'm
purchase.
seeing it in all the big banks. I'm seeing it in all the, especially
Yep.
the wealth teams, but I have not seen it in IMBs yet. And
Yeah, because IMBs don't make us, because the margins are tested. They can't afford, IMBs cannot, because their cost to produce is so high, they cannot afford to offer a HELOC, a second, or an IO. They need the 30-year fixed. Obviously, most customers default to it. But look, a 30-year fix has never been lower than an IO, ever. And we just spent 2.5, 3 years with 30-year fix better than the short term. So get ready. It is going to change and going to change fast. Now, what is that loan worth? It's worth less, right? An IO, a bullet, a 5 or 7 or 10-year loan is worth a lot less than a 30-year fixed rate loan. So that means margins will be tested, rates will be lower, right? Consumers, if I just did one with my kids, right? And it was the same. Went to US Bank, and the rate was a point lower, right? In rate for the first 7 years. So you got a market that's 6.5 and 7, and I'm closing in the low 5s. So great loan. So now I think it's also harder to do buy ups, buy downs. It's harder to do 1 year. All those things are a little bit more difficult when you start doing it. And these are just standard 700 FICO plus normal people who can qualify, IOs, right? Forget the HELOCs for a second, a whole different kettle. But the other piece is most of the time IOs restrict because of not just the complexity, but because of the risk of the instrument. They're not as aggressive generally in high LTV lending, especially with cash out, right? So I think you have to prepare and get your guns ready to be focused on these products initially, and maybe as 2025 sort of bears itself out, you're able to then get back to 30-year fixed. But I would think that your early customers, your early adopters, are going to be HELOC people who want cash out, and they don't really understand. I just actually wrote a piece for U.S. News and World Report, and I tried to explain it. I did it in a way that if I was a client, what would I offer them, right, for a refinance? And I walked them through a second, a HELOC, a mortgage loan, an IO, and a reverse, and an HEI contract. A no payment deal. I said most of my clients, they go from all over the map, right? Where I want a payment, I don't want a payment, I can't afford it, my job is over, I need this, I need the money, whatever, right? So you got all those things swirling around, but most good loan officers walk through those steps, right? And they offer, I think that's the cool thing, is that as an independent mortgage banker who works with MortgageCoach and Trust Engine, and they're really good at what they do, they're experts at giving the client the market, right, and what's available to them, not just this when you go to a bank, or this when you go to your credit union, or this. And I think that's in your sweet spot, gang, because this is going to be totally different. Because when clients want cash out, underwriters get restrictive, and so do LTVs. And so I think it's more in our wheelhouse. We just have to be ready with all these alternatives. And how do we do those? If you're going to broker your reverse, or you're going to broker maybe an HEI loan or something like that, where you don't even understand it, but the client doesn't want a payment, how do you do that? And I think all those things have to be, set up along with your comp plan in order to be ready for this. And it's going to be different.
Right. No, I totally agree. Now, do you think actual interest-only ARMs will get to the IMBs this year?
Yeah. Oh, yeah. I'm seeing it. That's a great question. I think one of the things, I work with MaxX, I work with companies like that. And MaxX is a good example, right? It's an exchange. MaxX offers, they've got 35 investors on this side and hundreds of sellers, all these IMBs, banks, everybody else on this side. And sometimes people play both sides. Like, you could be a seller, like a big player like JP Morgan, and be a buyer as well. But at the end of the day, what I'm seeing from the buyers the buyers are beginning to shift their desires and move to IOs already. Now, it's a slow migration, but it's starting to happen already.
So I actually did a podcast today with Jim Deitch, and
Yeah.
and he is all about, hey, there's about 30% of your loan officers that are driving all your profits, and the other 60% are anywhere from
Driving all your losses.
yeah, either driving your losses or breaking even. And really there's like a 30% that you're making all your money from, 30% that you're breaking even on, maybe losing a little bit, and 30% that are just taking it all. And we aligned on this single touch point. Like, we run a credit report, credit reports are going up, so the expenses of credit reports and on goes up. And when you give a fee worksheet, you make 10 basis points less in margin, and the data proves that. And Jim thinks that a 10% higher in conversion rate, he guesstimates this at about 13 basis points. So I don't know. Whatever. Do the math. If you are an operator, what would a 10% higher in credit report to funding, what would that do in basis points? Jim, shooting from the hip, thinks it's 13 basis points. So we're talking this single touch point of, I get a credit report, we give this versus this is 23 basis points. And and so Bill, what can I tell lenders to get more serious? Like literally, I think, what was it? 19 basis points is what the industry made last year. And they're sitting on a single best practice touch point that and tell me if you think I'm onto something. With credit reports going up, that's going to give you some leverage with your loan officers to get them to treat that credit report in a way that you want them to. And there's probably some levers you could play with that. Mitch Kiter saying that, you know what? You can comp higher conversion. You can actually have incentive compensation for higher conversion. Don't you think there's some way for an IMB to mandate's probably not the right word to use, but to incentivize loan officers to deliver that mortgage coach experience to every credit report? What are your thoughts on that? Spitball with me.
Yeah, I mean, I think you can. I think, like we did, I think when you offer the things that you could do to incentivize really mortgage loan officers so that they make more money. I used it more as a retention tool before, right? So higher conversion, more purchase, however you want to do it. There are some levers that you can pull that allow you to actually get, I think, better conversion, keep your better loan officers, and offer lower rates or offer market rates. I think, like you were saying, I think it's very difficult to do that across all your LOs, right? Because they're just so different. And so I would say, I mean, I have not seen out of the 10 or 15 clients that I work with this last year, I've not seen anybody really try to key it back to, I'm going to say, lower expenses associated with the loan. Although that's a good idea.
Yeah. What about first of all, what would hold a lender back from providing more transparency around conversion? So everybody in the company knows how many loans every loan officer closes, what their production is. What would be a reason not to create conversion awareness so that
I think a lot of it is just the naturalness of trying to create a socialist type plan versus a plan that's focused on the best, right? I think mortgage companies sort of vacillate. The smaller companies are more geared to guerrilla warfare and keeping a few of the best people, even though I would caution sometimes they're not the best, they're just theirs. But at the end of the day, they're more team oriented, they're more team. And I think the sense of team is one issue that keeps people from doing it. I know what we used to do was just put them in tiers. I would just have 3 tiers of LOs and then just publish it.
Okay. So you
Right.
could have 3 different conversion tiers and make conversion. What are some other metrics?
Closing loans per, I think the other thing that we did is we did 360 reviews. Part of what one of the challenges that mortgage companies have is that LOs stomp all over operations. So we would do conversion rates, we would do purchase or whatever else. We could incentivize other products, treating other employees well, and doing things cost efficiently, right? All of those you can sort of build basis points that you can add to a comp plan that I think either helps you retain the LO, but it also helps differentiate and incentivizes the proper behavior. I mean, I guess that's the point, right? You want top producers, but like Northwestern Mutual Life and everybody else taught us, you build your company on the medium producers who are very good and they're focused on the organization itself, and then you have a few outliers on both ends, right? I think the challenge, like you said, I do think the mortgage business is littered today with almost this barbell approach. Great producers who are doing really well, and the folks who aren't cutting it.
Yeah,
And
well,
it isn't going to get it. It's not going to get any easier.
no, but it can get profitable in any market. And the case I'm trying to make is that the conversion score, it is part of the customer satisfaction score. Because
For sure.
if you've got it's your sales satisfaction score. If you
Yes.
converted a customer, they trusted, they respected, they
Mhm.
committed, and if you have a high score, that means you're really good at trust and commitment. And if you don't, then that means you're not. And if you gamified that and
Mhm.
recognize that, uh, then the behaviors that drive conversion would happen. And then things like mortgage coach at the point of sale would would accelerate. Yeah.
Yeah, and I think, like you said, or I think surveys, sales experience, all those things that mortgage people should do, we should do more of. The challenge we have is those transactions are so complicated at times, and there's so many hands in the pot that's stirring the stew, right, to try to close a transaction. Sometimes you have very little control, and sometimes you don't. I think at the end of the day, that's what good loan officers do, is that they are managing basically a very difficult closing of a transaction, especially in a purchase, because you've got other people involved that have to work and work just as hard. And I think that's one of the things that your product, like all of our LOs and everybody that we had, we always you could see a big difference between people that use Mortgage Coach and use the Trust Engine, use products that actually are more client relationship, client experience focused, and then the others,
Right.
the ones who are just showing up, praying, and that's what's really interesting about mortgage is how, because everybody starts as little babies that don't really know anything, and then they grow up and then go down these paths. So why are certain folks just killing it? And I don't think it's motivation. I mean, obviously there's all kinds, but the skill that your products offer really allow people to communicate and communicate well, the experience to a client. And that's what makes the loan experience different with an IMB versus a bank. And that's why you can charge more,
Right.
right, than the others, because they probably are going to have a lower rate, but they're probably not going to be as focused on what you do.
Yeah, no, totally agree. So before we run out of time here, any other things that you want to get? I feel like we've had our unplugged LO comp conversation. We've covered some non-QM opportunities. Anything
Yeah.
else you want to make sure gets
Yeah,
out
I
to
think
everyone?
I think one of the things that you and I talked about was, what are some strategic initiatives that LOs can think about that are consistent with what companies are thinking about, right? And so my 2025 strategic initiatives, I've called it Thrive in 25. And I use Thrive as an acronym, but the T is really take advantage of the major themes in mortgage and the tons of home equity that's available, right? That's one. H, right? The H in Thrive, help clients get cash out, right? You don't think this way, right? We have to think this way. How to get cash out? I have certain investors that are good at this, certain investors that suck at this, and most loan officers don't think this way. And the agencies hate cash out. So the R, right? Reduce your cost to originate. Like you said, every dollar I can save in cost to produce, I can offer in a better price, whether it's in fee or rate, right? And I'm guaranteeing you the companies and loan officers are going to have to cohabitate in this. How do I offer a rate that is competitive with whatever these other folks are going to do as rates drop? The IOs are going to be important, and non-QM products are going to be important. Why? Because people are flippers, ADUs, rehab, they non-owner to owner to owner, HEIs, other things are beginning to show up. All of those are non-QM products. The V is volume, right? Volume should increase, but it has to be profitable volume. And you can't just do more loans and fix this. So you've got to be cost. And the E is really where I spend most of my time, really is how can you be efficient in mortgage, which is a very different. So I use Thrive in 25 and then try to focus on how we can all succeed together. And really what I'm trying to build in every mortgage company is how can you withstand anything, right? All the ups and downs in the market, all the things that happen from a macro perspective. How can you build a company that can withstand anything? And I live with two things. LOs, you don't need more LOs. You need LOs to do more. And you don't always need more loans, but you need to make more money per loan. Those two things are simple. They're just not easy. So I would leave, those are the biblical tablets that I try to live with each of the clients. And it is interesting because, most of these companies, are production focused. Production. Well, you need to be process focused and you need to be efficient and profitable focused first. And that's just not how we think. And we're pushed that way by our LOs and by our constituents.
And just to put some data stories behind what Bill just said, guys, like this is debt in America. I mean, it has exploded. And guys, we're in mortgage. We're in the debt management business and being strategic. This is equity in America. It has exploded. It's gone from 19 trillion
It's unbelievable.
to 35 trillion. And this is America's balance sheet. And when you really break it down, and as mortgage advisors, like loan officers, quote rate, deliver fees, close on time, give great communication, guys, that can be automated. It will be automated. It is being automated. And it is a commodity, but helping a consumer optimize debt and equity and achieve the American dream, guys, like that's everything that Bill just said. Like this is the data that supports the case he made. And it does require some new skills and some new habits. This, by the way, I have a question on this, Bill. So think of the cycle. First of all, let's get rid of this little optimistic line, because I think everybody I know, if we could ever just touch the fours again, a four handle, that's optimistic. And right now, today, we're at like 6.6 according to Optimal Blue. I actually looked at this while I was talking to you. And we did get down to 6.2 and we started to feel the opportunity zone, right? And rate and term alerts started to trigger. I know a lot of loan officers that closed a lot of loans because they were well prepared to they had a strike rate with those clients. They use Trust Engine. They're giving advice. But how low do you think we'll get in this cycle? Like, what is the Bill Dallas opportunity zone? Is it going to get into the fours like that? Or
Not this year. You might be able to get into fours and IOs if the curve continues on its path where because you still don't, I'm looking at it right now, you still don't have the the 6 month, the 2 year, the 10 year, and the 30 year. You don't have this nice curve yet, right?
yeah.
So we're getting there, right? Once the curve arrives, you could see, I think for sure, you're going to see IOs and products in the fives.
Okay, so guys, this is the
And
opportunity
you
zone
might
right
get
here.
IOs in the fours
Yeah,
in
no, I
2026.
I agree with all that. But this is the opportunity zone for this cycle. And all of this, guys, these are all people that they're not going to be doing rate and term refis, but you know what they will be doing? There's a lot of those people that they don't like the house they're in.
Dude,
They want to move up,
they
or they don't.
every I think the things that we need to take advantage of the macro themes. And what I've always tried to do with my LOs is say, we have never seen a market where you have, like you said, tons of equity. I'm talking tons of equity. So home prices aren't going to go down. Home prices are going to go flat to maybe up a little. So going to continue to grab it. Cash out loans are not easy loans for the mortgage market.
No.
They are the riskiest loans we do. So let's just start. Think about this, right? So now you're going to, and everybody's going to want access to their equity, whether they're going to want to, very few of them are going to want to pay off their existing mortgage, but they're going to have to because you're going to offer them a new first mortgage that will pay that off and give them some cash. And if you look at what people are doing, they want to age in their home. You have climate change issues. The housing stock in America on average is probably 50 to 60 years old. So you've got from lighting to heating to, all the major systems need upgrading. You've got also 15% of the market are flippers, and all of that will come for sale. Right, the first-time home buyers are for somebody else, right? These guys, I mean, you and I, we've managed our real estate before. We've owned other property. It's a pain in the ass to own a single-family residence, and especially if it's got your son or daughter in it. So I think you've got student debt that needs paid off. You've got other debts rising. You got everybody on the planet swiping left and swiping right and borrowing money and buying shit. I mean, we just came off of Black Friday, Cyber Monday. It's like, I've never seen so much consumption. So paying off debt and then getting your property right is going to be what we're going to do. And cash out, just make a note, is more restrictive than anything else that you do. So be ready. Because people are going to start looking at clients.
Yeah, but
and be mindful of credit risk.
Yeah, but it's going to be a great opportunity for
it's your sweet spot.
It
guys.
is the
it's our sweet spot.
So Bill, before we wrap up, I know you've gotten even more involved in First Home IQ. I truly believe that the mortgage industry is so well positioned to put a dent in the financial literacy crisis that we have in America, and to help proactively get more people into homeownership younger, faster. I know you believe the same thing. You and I believe the same thing. But if you could just give some closing thoughts on your call to action to the mortgage industry to join this movement, get more involved in First Home IQ. What are some of your thoughts on that?
Yeah, become an ambassador. Help people. I mean, first, this business for most of us has been very fortunate for us. We all sort of wound up here. I don't think any of us actually planned on it. And there might be a few people, but clearly wasn't me. And
Yeah.
And so when you look at it, look at what it's given to us. And so I think giving back is important. And I think making an impact and giving back is important. So become an ambassador of First Home IQ. And why is that important in your community? If you go on Dallas Capital and you sort of look at what we stand for, I think helping people and helping your community is good for your business as an LO. And I think it's good business just in general. And so I think what I try to do is say the sooner a person can understand how transformative owning a home is to their strategic wealth, long-term survival, the better off America's going to be. And so I think starting in high school, like we do, with understanding credit, understanding what you're supposed to do, like you and I talk. I mean, like all my kids, one of the first thing I try to help them understand is how to own a home and how important it is to own a home, how difficult it is, right, to own one. But it is transformative, and sooner that you could do it, the better. Now you look at people of color, you look at the underserved markets, you look at minorities and other folks. They don't have quite the push that what I'm going to call the mainstream majority does in America. So our job has to be, if we're going to solve the community issues that do exist between the haves and the have-nots, then the only way to do that is by community. And the only way to do that is to dig into the underserved market and help them understand how transformative this really is.
So
and I'm passionate like you. I live my life helping other people own real estate, and that has made life really good for them, right? And oh, by the way, every time you're doing something for somebody, it's like the greatest job ever, right? And I fell into it. I can't believe it.
Yeah, no, we are lucky. So check it out, firsthomeIQ.com. The money milestones are really simple. By 18, you should understand how credit works and how it'll impact your life. By 21, old enough to drink, you should understand how transformative homeownership is. And there's every family, every parent wants to help their kids have a great life. And some have resources, some have equity, some have means. The best down payment
Makes it
assistance
easier.
program.
There's a little safety net for those people, but
Yeah,
it's no
but
different.
but parents that don't have the financial ability but want to help them, First Home IQ has the information, shows them where to get the down payment assistance program, shows them how to get into home ownership. And it's a crime that everybody in America doesn't know that you don't need 20% to buy a home. Like most people can get into home ownership easier than they think. So Bill Dallas, it was great going unplugged with you, brother.
Thank you, man.
I love that little bonus at the end, you gave 7 strategies to thrive in 25. So that's nice. That's catchy. That's good.
um, promotion is 90% of sale.
Yeah. Well, you do a good job of communicating. Well, I appreciate you. If you got value
Thank
from
you.
this, guys, give it a like. If you're a loan officer, share this with your C-suite. There's a lot of value for the executives. For executives, share this with your entire team. I think this is a good way for you to have the LO comp conversation with your loan officers. Let Bill and I have that conversation. And for any loan officer that sends me a comment that says, "Oh, lowering LO comp's going to put anybody out of business," well, then they're not doing the business right. Like I would only propose adjusting your comp if it was going to improve your conversion, if it was going to make you a more valuable partner to realtors, if it was going to help you make more money, because right comp means that you are achieving your goals. It means you're making the money you want to make, you're closing the loans you want to make, if you have the right comp and if you're delivering the right product to consumers. And hopefully we'll get the industry to elevate the product that we deliver. It's not a loan. The product we deliver is homeownership, wealth with real estate, and financial freedom faster. That should be your product, financial freedom lending. Take care, everybody. See you later, Bill.
Thank you. See you, buddy.